Welcome to today's Explainer. If you've been keeping an eye on the tech sector lately, you already know that IBM has been on an absolute roller coaster ride this year. And when I say roller coaster, I mean the kind that genuinely forces you to reevaluate your entire portfolio strategy. Let's just establish exactly where we are right now. As of August 2026, IBM is trading right around $228.85 per share. Now, that means it's down about 21% year to date, but what's way more significant is that it's sitting a staggering 31% below the 52-week high it hit just back in June. So how does a legacy tech giant flying that high suddenly hit such incredibly heavy turbulence? Well, today we're breaking down the data to find out. To really understand the gravity of this situation, you have to appreciate the sheer scale of the drop. On July 14th, IBM shares plummeted 25% in a single trading session. Let me put that into perspective for a second. For a company as mature, as established as IBM, moves like this are practically historic. In fact, this was actually IBM's worst single-day drop since 1987. Yeah, the year of the infamous Black Monday crash. Okay, let's dive into this and map out exactly how we're going to unpack it all today. We're going to cover 1. The Q2 crash, 2. The bull case, 3. The bear case, 4. Analyst sentiment, and 5. Key catalysts to watch. Starting right off with Section 1, the Q2 crash, and what exactly happened on July 14th. The primary catalyst that completely shocked Wall Street was a highly unexpected pre-announcement of their second quarter earnings. The market essentially reacted like someone had pulled a fire alarm, and the damage was absolute. That 25% drop wiped out approximately $68 billion in market value in just one day. Poof, just literally gone. For anyone holding the stock for stability, watching $68 billion evaporate is the ultimate wake-up call. So, what numbers could possibly justify a sell-off of that magnitude? And this brilliantly illustrates exactly where that disconnect happened. Wall Street was expecting $17.86 billion in revenue, but IBM delivered $17.2 billion. That's a 4% miss, yielding only a tiny 1% year-over-year growth. And looking at the bottom line, analysts wanted to see earnings per share of $3.01, but IBM came in at $2.93. Now, in a vacuum, those misses might not seem entirely catastrophic, right? But in a market that is heavily priced for perfection, missing on both the top and bottom lines is a major, major red flag. But, top-line numbers don't ever tell the whole story. The real damage becomes incredibly clear when we break down the individual segments. Infrastructure revenue dropped 7%. But the absolute crown jewel of IBM's business, the IBM Z mainframe segment, collapsed by 42%. That is definitely not a typo, a 42% drop. Meanwhile, consulting, which is supposed to be this super steady growth engine for them, stalled out completely at just 0.2% growth. Tying it all together, operating income was down nearly 20%. This stark contrast between basically flat consulting and a catastrophic collapse in mainframes is exactly what spooked investors so badly. So how does leadership explain a miss like that? IBM CEO Arvind Krishna was actually very candid about it. He stated, "These conditions require our teams to execute perfectly, and this quarter, we faltered." He went on to explain that in the final weeks of June, enterprise customers suddenly shifted their spending habits. They were rushing to buy AI hardware components, things like servers, storage, memory, because supplies were becoming super constrained. And that sudden, frantic rush came at the direct expense of IBM's higher-margin software and mainframe products. Basically, IBM got completely caught in the crossfire of an industry-wide AI infrastructure spending surge. Let's pivot to Section 2, the bull case. What are the hidden strengths here? Because despite this disaster, there is objective optimism to be found. Why might the smart money still see a massive bargain hidden in all this wreckage? Well, the answer lies in their software division, which is really the true hero of this narrative. Software revenue now makes up 45% of IBM's total revenue, but here is the absolutely crucial takeaway. 80% of this specific software revenue is highly predictable recurring income. It's sticky. When the hardware cycle fluctuates wildly like we just saw, this massive software base acts as a huge anchor of stability. Let's rapid fire some of these bullish metrics so you can see exactly how strong that anchor really is. IBM is sitting on $24.6 billion in annual recurring revenue, which is up 8% year over year. Next, look at their generative AI book of business. $12.5 billion inception to date. This proves that IBM's AI initiatives are generating tangible, real money, not just corporate buzzword hype. Add in a very attractive forward price to earnings ratio of 19, which is cheaper than its historical average, and a nearly 3% dividend yield backed by 31 consecutive years of increases, and you've got yourself a very compelling safety net. Now, what's really interesting about this slide is what it tells us about customer intent. Approximately 40% of the deals that slipped and missed the Q2 deadline have actually already closed within just 3 to 4 weeks of the quarter ending. This incredibly fast recovery suggests that the Q2 miss was primarily just a temporary timing issue, a deferral of spending rather than a total destruction of enterprise demand. Plus, free cash flow actually surged 70% year over year, which means their underlying cash generation is genuinely improving. But to maintain our objective approach, let's jump into Section 3, the bear case. We need to talk about the risks and overhangs. We have to examine the very serious risks that are making institutional investors incredibly nervous right now. First and foremost is the legal overhang. Multiple major law firms, including Blakemore Fontainhold, Pomerantz LLP, and Higgins Berman, have launched securities fraud investigations. Higgins Berman specifically stated they're investigating whether and when the company may have had information raising the probability that large deals were unlikely to timely close. The gravity of this just cannot be overstated. These probes are actively questioning management's credibility, which naturally creates a massive risk cloud over the stock. And moving over to structural concerns, a much larger bear thesis begins to form. On one side of the tech industry, you have this massive rush to fund AI hardware. Companies are just throwing money at NVIDIA GPUs, servers, and storage. But on the other side, you have IBM's core business. The huge concern here is that this AI hardware rush is actively crowding out the budgets that are normally reserved for IBM's enterprise software and legacy hardware. Furthermore, Q2 broke a solid 5-quarter streak of IBM beating estimates, and their cash and equivalents fell 40% year over year. So for the bears out there, this isn't just a one-off blip. It looks a lot more like a structural pattern. So, what does the street think? Section 4, Analyst Sentiment and Wall Street's Verdict. With a really strong software business clashing directly against massive legal and execution risks, how are professional analysts interpreting these heavily conflicted signals? Well, when we break down the consensus of 27 major analyst firms, we see 15 buy ratings, 11 hold ratings, and only 1 sell rating. Averaged out, this is officially considered a moderate buy with an average price target of $265, which does imply some upside from current levels. However, let's be real. 11 hold ratings out of 27 means almost half the street is just sitting on their hands. That is hardly a ringing endorsement for a speedy recovery. And when we look at the specific actions of the major banks, that caution becomes even clearer. JPMorgan slashed their target from $291 way down to $250. Citigroup dropped theirs from $255 to $245. And Jefferies took a massive cut from $320 down to $260. Notably, while Oppenheimer downgraded the stock to neutral, most of these banks, like Bank of America, who maintained a high $330 target, are actually keeping their buy ratings intact. This signals they still fundamentally believe in the company, but by aggressively cutting their targets, they are absolutely demanding proof of a recovery first. Which brings us to our final section, Section 5, Key Catalysts and What to Watch Next. Based on all the data we've analyzed today, what exactly do you need to monitor moving forward to see which way this stock is actually going to break? So the crucial point is centered on 3 upcoming events. First, Q3 earnings in late October. The market desperately needs proof that software growth is approaching that 10% mark and that those slipped deals we talked about are fully recovering. Second, any updates on those securities fraud investigations. If there's a formal complaint filing or class action certification, that'll be a huge headwind. Third, we need to see signs of a mainframe cycle inflection. That 42% drop in Q2 has to stabilize. These 3 specific events will absolutely decide if the stock pops back up or takes another brutal leg down. Synthesizing both the bull and bear arguments from our sources brings us to this final verdict. IBM is currently contested, unresolved, and firmly a wait-and-see stock. Yes, the value metrics are incredibly tempting, the software franchise is remarkably durable, and that dividend is super strong. But right now, those positives are heavily weighed down by undeniable execution uncertainty, structural spending shifts in the broader market, and those lingering legal probes. The upside potential is definitely there, but it is just not confirmed yet. As a quick reminder, this explainer is strictly for informational purposes to help you understand the source material and market dynamics. It is definitely not financial advice. But looking at all the structured data we just walked through together, the question remains, are you objectively bullish or bearish on IBM's future? Take these insights, weigh the evidence we've covered today, and definitely keep a close eye on those upcoming catalysts. Thanks so much for learning with us today, and we'll see you in the next one.